Hello, everyone, and thank you very much for joining us for our Curious About Corporate Development series. My name is Philip Hodson. I'm a director at Altus Partners. We are a private equity-focused search firm based in London, and I manage the CFO and corporate development practice here. Purpose of today, actually on quite a big amount of demand. We get a lot of younger candidates, senior candidates, whether it be sales side or buy side, looking to get into corporate development and really looking for information about how to get into it, and also what to expect, more importantly, when you do get into it. And the purpose of this is really just to take the luxury of meeting with individuals that are going through that journey. And I'm delighted to say that I'm joined by Alex Perry, Head of Corporate Development at Aspen Pumps, which is backed by Inflection. Alex, welcome. Good to see you.
Thank you, Philip.
I don't know if you'd like to sort of introduce yourself and give the guys a little bit of an introduction as to your background.
Sure, happy to. So I've been in private equity-backed corporate development roles for about 7 years now. Most recently, roughly the last 5 years at Aspen Pumps, backed now by Inflection, as Philip mentioned, and before that by 3i. I joined there in 2017, growing that business significantly, and we managed to achieve an exit from 3i onto Inflection early on in 2020. And before that, I was with a Bain Capital-backed business in Brazil.
Cool. Yeah, no, and thanks again for joining us. I think we're super excited about this. Just given the kind of breadth of background of working in large cap backed institutions, backed by Bain, and mid cap, upper mid cap businesses backed by Inflection. It should be a really interesting and useful discussion. So thanks again for joining. So I think we've had a number of questions come in from various people, and I think one of the big thing, it doesn't matter even if you are a senior person who's already in corporate development moving into another corp dev job, or a senior associate at a bank. There are more and more, quite a lot of corporate development opportunities coming onto the market. Obviously M&A is very buoyant currently, and a big question that they always ask is how do you quantify what's the right opportunity? What's the right opportunity for an individual? So I mean, the first question is, in terms of due diligence and looking at mandates, what advice would you give to people looking at moving into corporate development, just to make sure that these mandates are right for them?
Yeah, sure. Happy to. So look, I mean, I think these are dynamic roles. It's interesting work. You're inside a business, really driving it forward, creating value, sort of building a great business that you're proud to be a part of. So these are I think these are very attractive roles. You can see why it's attractive for the individual as well, because if you're in an environment where asset values are kind of rising faster than incomes in many situations, it sort of makes a lot of sense. I mean, if you've got the chance to join a company where you've got the ability to participate on the equity of the business, that makes a ton of sense. It's an enormous privilege, really. And you can see also it makes a lot of sense from the fund and from the company perspective. If you've really got if you've got any level of ambition to do deals regularly, then I mean you could make a strong case that having a person internally is a significant cost saving, and then on top versus the advisory fees, and that you're effectively kind of cutting out, and then on top you're building capability inside your portfolio company, and then I mean you're seeing these roles become more and more popular. We're in an environment of sort of quite elevated acquisition multiples, and it's become the accepted wisdom. And there is a lot of research, but sort of underneath that, demonstrating that bolt-on M&A is associated with top quartile returns. So funds are really looking to M&A as a sort of lever to derive value in some of these deals where they've gone in at a sort of what historically certainly would be seen as a sort of high-ish multiple on the way in. But I mean, from the individual's perspective, I think that you've really got to think of yourself as an investor, like you're primarily investing your time more than anything. You know, that's one thing you can't really diversify away, right? Where you place you're working, the place you're going to be putting in years of your labor. And I mean, I always think of it as three questions. So the first two being like classical investment questions. So can the business achieve its business plan in terms of its growth? The second one, you know, have they got a realistic exit at the end of that growth? You know, is someone going to come along and buy this business at the end of that plan? But the third one is, you know, are you going to be around as an individual to see that? Because you know, the remuneration in a lot of these opportunities are all tied up with being around at the end of that process or at the exit. So I think it's actually a really challenging thing for the individual to sort of really test themselves about you know, what you really want, and whether you really want to be there for what's going to be actually a really long-term process. But private equity is a long-term journey. You know, people used to talk about 3-year rides. Now maybe it's a 5, and maybe at the end of the 5 there's a rollover as well. So suddenly it can turn into a 7-year, an 8-year, a 9-year journey. So you have to be comfortable that you're prepared, that you're excited, and willing to sort of be part of that business for a very, very long time, to really see it through and sort of take the benefit of that hard work you've put in.
Yeah, I think there's the big point as well. I mean, what do you think? So a lot of, I think, you know, associate level guys from, you know, banks and consultancies sometimes see corp dev as a route to PE. Now, it's an interesting option now because very, very rarely does it happen. I mean, what do you say to guys who almost look at corporate development as a route to an investment mandate?
Yeah, I would advise them to kind of look again at that sort of thesis. I don't think it's not regarded as an entry point into investing. If you want to, you know, if you want to go into investing, then my advice would be get into investing, yeah, you know, at some other fund, or as an intern, or on a consulting basis. You know, I think in the PE world, once you're kind of an operator, you know, as in part of a management team, that it's sort of difficult to branch out to sort of get back into the investing side from there. So you know, it's not. I'm not saying it can't be done, but I don't think it's. I would advise people to do it because they're interested in doing it, not because they think it'll take them somewhere else in a different direction.
No, I mean, totally agree. I think so many people. I think mainly just through the frustration of how difficult some, you know, buy-side processes can be. You know, getting into a fund, almost see it as an option. So I think, you know, certainly from my experience, if you're moving into corporate development, appreciate that this is not, you know, an opportunity to get into PE. It's an opportunity to be effective within industry.
Yeah, absolutely. But you got to bear in mind as well that the fund environment's enormously fragmented. So, you know, it's like anything. You know, if you put enough into it, if you run a process, you know, you will find that's comprehensive enough. You know, if that's your ambition to get into investing, I'm quite sure you'll find a fund that will take you on in some capacity.
Okay, cool. No, great advice. And again, I guess when, you know, when people are in the, you know, getting in is one thing, but then obviously once you start a corporate development role in a PE-backed asset, you know, there's nuances to every business. You know, there's not a one size fits all. And I think the great thing, and why I was excited to talk to you, Alex, was, you know, you have got experience of working in, you know, large international businesses, you know, Bain-Capital backed assets, and where you are currently with Aspen backed by Inflection. In your experience, what are the nuances of working with a large cap investor and a mid cap investor?
Yeah, sure. So I think the first thing everyone will tell you about working sort of in the PE, the wider PE environment, is that every fund is different. Every fund has their own idiosyncrasies. They follow what has worked for them and build around that. and develop their own approaches. There's very little that's kind of standardized. So if you'd force me to generalize, then I think you do see quite distinct patterns in the mid-market versus on the larger cap side. So I think if you're going to generalize about the mid-market, the value creation is really focused on growth. You're talking about kind of like the fundamentals of how they manage the investment, a little bit different. So each investment partner has got quite a high number of deals that they look after on an ongoing basis, in addition to their new deal workload, and there typically isn't. There's either a very small or no sort of dedicated portfolio resource in the background. So and you contrast that to kind of larger cap environment, where I think you typically get a more balanced value creation story. So there's always going to be a little bit of growth, but there might be some more stuff on the cost side, or reorganization, getting in and out of businesses, maybe a more structured approach on the M&A side. And there's also kind of like there's much more often there's a dedicated portfolio resource within the fund. And what that means is you just get a slightly different relationship between the management team and the fund in each of those settings, where I think in the mid-cap space you've got a model where you've got more of an autonomous kind of management team, where, well, maybe not more autonomous, but you've got more autonomy certainly as a management team. The fund is still running the classic UK mid-cap model. You're still running a very kind of classical approach of the investors turning up for a monthly or bi-monthly board meeting and kind of influencing and sort of exerting control over the business through that mechanism, rather than, I guess, on the large cap side, they've got these much more resource to go and really throw into the business on day one and kind of just make stuff happen that they want to happen.
Yeah. And what about, I don't know if this is the right way of putting it, but I guess the sort of stakes involved, because, from a lot of the people I have spoke to about this previously, about differences of large cap and mid cap, certainly in an autonomous corporate development role, it's just the scale of the challenge. By all accounts, it should be easier to increase EBITDA from 5 to 10 million sterling than 50 to 150 million sterling. So how do you kind of rationalize that challenge as well?
Yeah, absolutely. I think that's right, and I think that feeds into the point about mid-cap being really about growth, because sort of at that kind of 5 million EBITDA size, even in a small market, you can win and grow your business. Whereas I think the larger the company gets, the more you get into the fundamentals of strategy about market size, market growth, because in most situations, kind of sudden market share gain is sort of very, very difficult to achieve. And so for the larger cap side, to assume that you're going to heroically kind of outperform the market is very, very difficult. So on the mid cap side, you're very often looking to double your business. I'd say on the larger cap side, it's normally a much more modest increase. It's relatively rare you'd say to see a business plan that's about doubling the business when it's on that larger cap side. It's more of a as I said, more balanced value creation, more going on with leverage as well underneath it.
Yeah, very interesting, very interesting. And one thing I was really keen to say, obviously, that differences between large cap and those mid cap businesses. Obviously, you've had that exposure, which is great and gives really good insight. Obviously, from your background, having worked in corporate finance at BDO and then going on to strategy consulting at BCG, I always find it quite interesting because corporate development attracts quite a varied candidate set. Whether that be bankers, people from strategy consultancies, or frankly people from industry or finance roles. But having worked in both those areas, in consulting, and corporate finance, what skill set do you kind of draw into most, and what do you utilize, and what do you find more valuable in terms of experience?
Yeah, I think it's a really good question. I think, yeah, I have done a fair bit of M&A advisory. I spent a couple of years at BDO Stoy Hayward Corporate Finance back in the late thousands, and more recently consulting with BCG in between 2011 and 2014. And yeah, I mean, I really rate both skill sets. I think if you're coming from either background into a sort of into anything but the largest sort of buyouts, then you're going to be a fairly unique resource coming into the company that you're joining, and you're going to be very well positioned to get very interesting work and sort of develop a position and a career inside that business. I think there's, on the deal side, on the banking side, I think there's certain things that are just kind of non-negotiable. Like you have to understand the fundamentals of the deal process. And I mean, the good news is it's sort of relatively straightforward to learn. None of that is in of itself rocket science. So I think that can be difficult if you've got absolutely no deal experience on the M&A advisory side. But actually, I think that the real differentiators are actually kind of the softer skills, people skills. I think that that things like your likability, your influencing skills, your negotiation skills in the deal process, your just kind of personal productivity, attitude, enthusiasm, ability to get stuff done, generate output. I think it becomes much more important than, either on the, if you're going to be cliche, it's not about having an excellent model. That's not going to make a bad deal into a good deal on the M&A side, and equally it's not about having lovely slides either. So you sort of I think you have to take the best parts of your experience and try to put it together and sort of figure out the type of professional you want to be and what's needed for that role.
Yes, it's an interesting one, isn't it? Because we get a lot of mandates, certainly in pan-Europe, kind of buy and build plays, corporate development in healthcare services. So, one of our bigger clients is doing a buy and build of dental practices. And, a big thing for them is, we don't want Wall Street to come to, rural Germany and start telling dentists, what to do with their life's work. And I imagine that kind of owner management piece in any industry is like I say, is equally as important as the model.
Yeah. Look, I mean, you're absolutely right. Like as you get in there and sort of define the strategy, the M&A strategy you're trying to follow, I think the fundamentals of what you're doing will fall out of it. From the fragmentation of the market you're in, the financial firepower that the business has, the appetite for deal making that they really have. And yeah, look, if you're in an environment where you're buying, when you're dealing with the first seller in a way, an owner selling their business for the first time, that's going to be a very, very different set of demands than if your counterparties are sort of grizzled veteran financiers and sort of a heavily advised type setup. So it's going to be a very, very different thing. It's much more about personal relationships and the softer side that I was referring to.
Yeah, no, really, really interesting. And I guess it's on that as well. I think it's such subject to the fund, the situation. I guess it comes back to the due diligence question we were talking about before. If a fund is looking for someone to, on a buy and build to work autonomously, then you're going to have to be able to, really complete that kind of inception to completion M&A deal. But I don't know if this is the same in your experience, but, a lot of mid-market players might be more open to, someone with a slightly less kind of 360 M&A experience, on the basis that their investment managers can assist as well. Is that something you've had exposure to?
Yeah, I mean, look, you're not on your own. It's a fundamental thing. So in a typical buyout, like I think on a typical buyout management team, most of the people on that team will be, if not lifelong, then 10-year plus veterans in your industry. And so the the idea isn't necessarily to be the Superman that's doing all of the knocking on doors and delivering every deal kind of on your own, and this kind of thing. The way through it is often to leverage the expertise and relationships that these kind of lifelong, very high quality industry professionals from whatever field it is that you're in, that they already have, to open the door for you and to go in and sort of get these things done together. And certainly at the lower end, it's very common to see the CEO of a business very, very heavily involved in the origination effort, and the CFO is clearly highly involved on the execution side too. You also see, I think what you were getting at there, you see different models in terms of how the fund supports the bolt-on M&A process. So it's good to get those expectations cleared up on the way in. Some funds will see bolt-on M&A as just fodder for their sort of junior investment managers and associates to on the deal teams to sort of learn the ropes and earn their stripes. Others will just not want to be involved at all. They'll say, if we're not putting new money in, then we don't want to be involved. Like, show us the results. We want the investment paper for the final decision at the board. But otherwise it's over to you, chaps. And on the larger side, they might be willing to throw sort of, if they're being asked to sort of put new money in, they might be willing to throw quite significant deal resource in. So there's no one model, and as I said, funds can be very idiosyncratic in their approaches.
No, it's really interesting, and like you said, there's definitely different models for every fund. And to be honest, we've talked a lot about funds, haven't we? We talked a lot about the private equity's role in and that relationship with a corporate development manager, head of corporate development, director, whoever comes in. But obviously, it's not just about the fund. So I mean, how would you? What advice would you give to someone going into a private equity-backed asset in terms of, managing both the fund and also your internal C-suite?
Yeah, I think it's a really important point, actually, and I think the strongest bit of advice, kind of once you've made your decision about going in, I think, is to put your management team relationships up there as your first priority. I think, and it can be your CEO or your CFO, depending on where you sit in the organization. But that relationship is what makes the relationship between the CEO, the CFO, the chairman, and the fund. Those relationships are what drive the business as a whole. So I'd say your first priority is always your relationship with your CEO and CFO, making sure that you're 100% committed as part of that management team. And then, I mean, to the extent you're able to build a relationship with the fund in parallel, great. But it's that CEO and CFO relationship that's the one that's most important for you.
No, it's really interesting, and I think a lot of people, when they, the PE is obviously the cool ticket at the moment, and especially kind of younger, more kind of M&A manager candidates are very obsessive about, who's the fund, finding out about the fund. But really, in terms of due diligence and what matters is you should really be looking at who's in that kind of key C-suite positions, who's going to be your sort of day-to-day mentors as well.
Yeah, look, I think I think you're in an environment. You've got to understand you're in an environment where your position in the business is all about, like, you're in a very, very tough position if your CEO and CFO don't have confidence in you, and so that, I mean, that relationship and proving yourself to them is far more important than kind of whatever the fund thinks, because they're not going to be as close to you day to day as those guys are.
Yeah, no, great. And I think, well, one thing I guess that we're just kind of wrapping up now. There's something that a lot of kind of having spoken rather to people about this before, is a lot of people stress when working either with PE or with C-suite management teams, the importance of a first impression. Those first 100 days within an asset. How important is that first 100 days and that first impression, and what advice would you give to people in that period.
Yeah, I totally agree. But I mean, the importance of the first impression is so important. I think that's true in PE, out of PE, in general in work. I think it's a truism that the time spent recovering from a bad first impression would be much better spent making a new, better first impression somewhere else. I think you've absolutely got to hit the ground running, and the PE environment. The PE-backed businesses pride themselves on being action-oriented, delivering results, and I think you've just got to come in with that energy, that enthusiasm, and just deliver tangible output from almost from day one, basically. That first impression goes a really long way.
Alex, thank you so much for your time. I think we've covered some really good information there, which I think if it wasn't for things like this, individuals looking to get into corporate development would probably struggle to get hold of. But we have gone around the houses a little bit. So, I mean, just to conclude and draw a line under it, if you were to kind of paraphrase, the last half an hour into 3, takeaway points, in terms of advice for people looking to get into corporate development, what would they be?
Yeah, sure. Look, I'd say firstly, look, make sure the opportunity is the right fit for you as an individual, what you're interested in, what really makes you tick, because this is really long-term investment of your time. You've got to make sure it's right going in, and that goes for the opportunity, but also, I guess, things like remuneration. Don't be scared to negotiate a little bit up front. You're an M&A professional, and that it's kind of to be expected ultimately, within reason. I'd say secondly, make sure when you get in there, make sure you're bringing energy, positivity. You're joining a private equity backed business that prides itself typically on being action oriented. You have to fit the bill, match that, or beat it. And deliver output. Deliver. You're going to be judged on your results. So just sort of get straight to your output. And then thirdly, I think it's the point about relationships. The PE world is a relationship driven world, and just make sure you build the relationships with your management team first and foremost, but also with the fund and internally in your business, because you're going to be there a long time.
Yeah. Good. Well, Alex, once again, thank you so much, and look forward to catching up with you soon.
Thank you, Philip. It's been a real pleasure.